Hello, everyone, and welcome to your Onchain update for the 6th of January. So, we talk quite often about realized profits and realized losses, and also unrealized profits and losses, as really one of the really powerful tools that we have in Onchain analytics. It goes a long way. It helps us understand a lot of what's going on about the market. The way I like to frame it, realized and unrealized is basically the locked in versus the currently held. So we've got two components: realized, unrealized. But we also have the cap. What is this all measuring? It's really measuring the wealth held in the system, the unrealized portion. It's measuring the capital inflows and outflows, the realized portion. And really, we can look at what's going on in terms of sentiment. Are we seeing a capitulation event, massive profits taken? There's a huge amount of angles that we can look at this thing from, which is essentially what we're going to do today. Explore one of the dashboards we've got from a few different angles on the lens of profit and loss. Now we're going to look at this from a few different angles. One is kind of macro market structure, right? Let's look at the big picture, what's been going on in the space. Where does it kind of set us up for the year that was and the year that's coming? And also a little bit about micro market structure. This is more of the daily time frame, trading indicators. Profit and loss really provides a very good tool set for that, particularly when we're looking at the SOPR metric. But anyway, it kind of gives you a bit of a structure on where we're going with this, and let's jump right into it. So one of the most popular, most important, and most significant metrics in the on-chain analytics space is the realized cap, and obviously it's a derivative, the realized price. So the realized cap is essentially looking at all of the coins valued at the price when they last moved. Right? You've probably heard this spiel 1,000 times, but this is it here. Now, what you can generally see, what I like to do with the realized cap sometimes is just look at it in linear scale and also just appreciate why it does what it does. So you can see that the 2018 to 2020 bear, now, whilst you're in the moment, it was nice and volatile and, up, well, it's not really volatile is the wrong word, but it looked like our current cycle. We get ups and downs and it's not a flat line. Now that you do what Bitcoin does, right, you go through these logarithmic cycles and it looks like a flat curve during that time. But in reality, it was, similarly all up and down. Now, what you can really see is that the realized cap goes through these kind of plateaus, right? Let's call them a plateau. This kind of looks like in linear scale, also a bit like that in log scale. But then it has these massive repricing events. And note that this happens during the primary leg of the bull. These up legs is showing that coins that were acquired at a cheaper price en masse are getting revalued to higher prices. So what that really represents is that someone who bought a coin for $1,000 is selling it for 10,000. Someone had to come in with an extra 9 grand worth of capital. So it's showing a net capital inflow. And much the same, some guy bought a coin for 50,000, sells it at 25. He took a 50% haircut, and that means that somebody came in with 25 grand, and the guy who invested 50 grand lost 25. And overall, the market is now at a position where you've seen a capital outflow. So it moves up and down in the realized cap, and the realized cap's kind of all the realized profit and loss metrics we're about to look at. They distill down. The net result is the realized cap. It's kind of the remainder, whatever is left after the fire and all the celebration and the champagne and the pain. After all of that has happened, what we are left with is the realized cap. It is the realized market valuation. Now, with all that said as context, our current cycle, let's just zoom in on a 5-year time frame to really have a look at what's going on. What I really want to highlight is here is our initial bull leg. Right now, we've argued that this is where the bear market really started on that first sell-off. Immediately, we started seeing realized losses and this thing started to pull back. Now, note that we saw a second leg of profit taking into this peak. That's a really important point, as is the fact that we plateaued and then saw capital outflow. So this is kind of your consolidation. The market really wasn't quite sure. There was still investing, but also selling. People hadn't quite started selling the top yet, but we also weren't necessarily seeing people taking the profits were offsetting the losses. So that's why we literally had a sideways market. But where we are at the moment, we've essentially seen a complete a flow in of funds. And for argument's sake, this particular rally, as we know, was a bit of a scam pump, right? We saw it push up to all-time high, but it really had a lot of FTX-ness to it. There was a lot of they didn't have the follow through on the on-chain activity. There's a lot of exit liquidity, speculative premium, monkey JPEG selling for stupid sums. That really was a bit of a scam pump. And what I want to highlight here is that the capital outflow we have seen since the all-time high has essentially completely removed and eradicated all of the value that was essentially misallocated during that period of time. So in many ways, we're kind of getting back to a bit of a flush out of the system. The system's reset, for want of a better term. And I think that's a really nice grounding level for us to go from that point on. Now, you're all probably quite familiar with the realized price and the MVRV ratio, so I won't spend too much time on this. Really, the key takeaway here is that we've been underneath the realized price for some time now. Really, it started back as far back as June, so we're talking about 7 months now. It's getting to the point where we're a little bit longer than 2018-19, and we're getting into the territory, not quite as long, but not far off as 2015. So duration in terms of time below the realized price, it actually looks fairly consistent to me with previous bears. We're starting to get to the point where a bit of upside momentum actually wouldn't surprise me. Now, we are still below the realized price. If you are looking for just a nice signal to say, yep, things are looking much, much better, the realized price is currently at 19,700. So fortunately, we're not too far away from it. I mean, again, in percentage terms, it's a significant rally. I would expect there to be some kind of resistance there, probably a little bit earlier too, about 18K. But if you're really looking for a healthy recovery, getting up and holding above, let's just say 20,000 for round numbers, is probably a nice way to just kind of take out some of the risk. If you're above both the moving at the 200-day and the realized price, that's a double thumbs up. So 2 metrics to pay attention to for those who are a bit risk averse. There's no prizes for catching the bottom. If you're looking for some kind of significant confidence, wait till we've been above the realized price and the 200-day moving average for at least a week. Even bonus points for a pullback and a retest of those levels. If we bounce from there, that's thumbs up. Now, getting into a bit of the realized profit and the realized loss. So we're just going to kind of explore this from a big picture. I don't want to go into too much deep depth with all these things. I just want to highlight some of the things that I'm seeing. So on the realized profit and loss, this is on a net basis, so you can see both of them, but really you can see the scale of the FTX losses. It's kind of coincident with the 3 arrows and then the Luna, right? I mean, it's kind of funny that we had 3 different events to punctuate the chaos of each cycle. But you can see that we had a lot go on during this cycle. And in terms of dollar values, this is in USD terms, you can see that it leaves 2018 in the dust. March 2020, I mean, look at it. It's tiny. It's very cute. What we saw this cycle was huge. And 3 capitulation events, all significant in their own right. Pretty good sign that we've flushed out a heck of a lot of sellers. Now, what we haven't yet done, there's still some realized loss going on. People are still taking the hit. There's also people coming in and buying. So again, for every side, there's 2 sides to a market. We are still seeing losses. And that's, at the end of the day, if we look at our realized profits have declined to basically nothing. 32 million in each day is bugger all. There's nothing there. So basically anyone with a profitable coin is just sitting tight. Now, that said, there's not many people with profitable coins. So, it's just because they're a small population. We are still seeing realized losses. So we're not quite at like seller peak exhaustion yet, which is quite remarkable. But it also tells you there's a bit of buy side demand there because someone's absorbing these coins. $250 million a day, that's not small money. Significantly higher than the realized losses. Now, if you're looking for a second metric to try and back up getting above the realized price, getting above the 200-day, again, giving it a bit of time and just waiting for that nice reversal. Really, what we look for here, this is the realized P&L ratio if you use Glassnode. This is a great tool. This one here is on a 7-day moving average. I'm impartial to it, putting on a 7-day, a 14, or even a 30. If you really want a confirmed strong recovery, wait till this thing turns green on a 30-day moving average. What generally happens, you get a couple of these retests on like a 7-day. On a 30-day, there's basically no retest. Once you break up and above, the market moves back into a profitable regime. Profits exceed losses. It's generally a really, really good oscillator to just watch for that punch up and out of the bear market and into greener pastures. So another great metric to pair with the tools we were looking at above. We could probably leave that. That's probably less relevant. Similarly, on the SOPR metric. So here we've got standard SOPR. So what this guy here is doing, profit and loss, it's taking the ratio between profit and loss. So it will be above the black line, which is a value of, I think it's 1 or 0. That's value of 1. It will be above 1 when profits exceed losses. And that means that people are making money. And when people are making money, they're more likely to tell their friend, hey, I made some money. And he might go, hey, maybe I can make some money. And suddenly you get this reflexivity come in, right? Bull markets are in many ways reflexive in that sense. So SOPR is more of a profit multiple on the coins that were spent. So that's taking the ratio between profits and losses, and we're looking for more profits than losses for a bull to start. SOPR is looking for how profitable were the coins that were being spent. And what you can see is that we also can see these capitulation events, and the FTX one stands out to a much larger extent. You can see it basically blows out of proportion, and these were quite significant as well, right? So these ones here back when this wasn't Luna, this was 3 Arrows Capital. When that blew up, that was equivalent to the one we had back here in July 2021, which was a massive, right? All these things are basically just eclipsed each other scale after scale. FTX was something else. This was just an enormous sell-off. The average coin that was spent was locking at a 25% loss. Now that's massive, right? I think it's the all-time low on SOPR. Now, what we do have is some of these spikes. As I mentioned, this is still realizing losses. We have not flushed out the sellers. They just keep going. But anyway, we will get there eventually. But you can also see there's a bit of a collapse back towards a zero bound. Now, we also had a collapse towards a zero bound prior to FTX blowing up. So what we're looking for, again, if you want to even compound that metric we had above with the P&L ratio, putting a SOPR onto something like a 30-day moving average, which let me just do it so you can see what this thing actually looks like. Really nice way to just look for a macro regime shift. This thing is a bit slow on me. Let me then zoom out. Once you put on a bigger moving average, it actually makes sense to kind of pull out and look at it at a slightly larger scale. So what you can see here, we typically spend the bear market on 30-day below. When we do get a break above and hold it, we return to clear waters, right? Break below, not so good. Break above, clearer waters. Break above, and here we are not even close. So again, one of those metrics you can just kind of sit back and be like, all right, there's no real rush to jump into anything just yet. Okay, so moving down to, here's our short-term SOPR. Pretty much the exact same story. It's starting to close in a bit more. The only delta here, this one here is going to pick up the losses from both long and short term. This is the whole market. Now note that this has got a bit of body to it. There's still losses going on at the moment for the whole market. If we go to the short-term holders only, really nice wedge. Now that short-term holder being a really, really nice wedge, and contrast that to our long-term holders who are getting worse. Long-term holders are actually locking in larger losses, while short-term holders are locking in smaller losses. So what's going on? Well, short-term holders bought recently. These are the buyers. This is the buy side. Who are the sellers? It's guys who bought 6 months ago plus who are still locking in losses. So what we're actually looking at here is the buyers are actually short-term holders. The people who are selling are the longer-term holders. We are seeing people flushing out from the top. Now, by the way, these long-term holders who are selling are not enough to offset the long-term holder supply. That keeps going up because a whole stack of these short-term holders are becoming long-term holders. I know it gets a bit confusing with the terminology, but think about it this way. There's a bunch of guys from 2021 still getting flushed out, and there's a bunch of guys who've been around for years who are going to become long-term holders, who get what Bitcoin's about, who are buying rain, hail, or shine. And they're the ones buying those 2021 guy coins. That's the real crux of this whole thing. So a really interesting dynamic, but I do believe what we're looking at here is the buyers on the top and the sellers on the bottom, which is kind of an interesting little dynamic. And to actually explore this in more detail, what we're looking at here is the ratio between long and short-term holders. Now, to save you going into all the details, which doesn't really matter, when the blue price is above the red price, long-term holders are getting smoked, short-term holders are the buyers. And you can see this typically happens towards late-stage bears, where this thing is above 1. Late-stage bears, and here we are, late-stage bear. And note also, just visually, you can see the time that this blue trace spends above the horizontal line typically is about that same duration. So we talked about the duration factor probably a couple of months ago. That was the primary takeaway. I believe we're getting to the point where we have that duration factor now. I think we actually have that component. And now really what we need is the catalyst. Now that catalyst, it could be DCG blowing up, but I've seen news today, the DCG looks nasty. It looks in bad shape. price is just a stable coin, not going anywhere. I feel like there's signal in that, but that's just me. But I do see this duration component is getting to the point we've seen enough damage, right? So the market can probably start to recover now. And I don't feel like we're not missing a puzzle piece, so to speak. Aside from, we've still got some top sellers, but there's always sellers, right? So we've got more and more of these pieces of the puzzle. And what we're now looking for is a bit of confirmation because we don't have it yet. What we're looking for is that confirmation back out of the bear that we may be headed towards some greener pastures. Let's leave that. So this is where I want to close on. This is some of the interesting metrics we looked at the other day. And I want to look at this from a few different angles. So on the top, we have unrealized profit and loss. On the bottom, we have realized. So the other way to think about that, the top two charts are showing us all of the coin value that people spent and locked in, right? Sorry, no, I take that back. The top two charts are showing us the amount of coin value or wealth in profit or loss that is still held. So the coins that investors still hold in their wallets and they're not spending them yet, this is how much profit and loss they hold. On the left-hand side, this top left chart is in USD terms. So you can basically see how many dollars we saw flow in as profit. And then, man, I'm getting this wrong every time. How much profit was held by the market versus how much is currently held in profit or loss. You can see that obviously the amount of coins in profit has deteriorated significantly. We're now pretty much at not quite the same, but similar level of profit to loss held. There's actually more loss held than profit. And again, this thing here is essentially showing us that we've got on net, the market's holding $160 billion in net losses, which is pretty significant, right? So 50% of the market cap is a loss. Tough, right? That's pretty brutal stuff. Now on the right-hand side, it's essentially corrected for market size. So as you can see on the left, as Bitcoin tends to do, when you go through market cycles, it gets logarithmic, right? You have to actually look at it from a per cycle basis. On the right-hand side, we're essentially normalizing for market size. And what I want to highlight here is that see the amount of red is very, very similar to our previous bear markets. This means that there's an amount of pain that the investor base is willing to hold, right? I have coins that are underwater and I simply don't care. I'm going to be represented in this red bar and I don't mind, right? I'm not getting flushed out by it. So you kind of reach this point of pain that's held in the market where investors go, whatever. I'm just desensitized stuff here. I'm not going anywhere. I'm going to hold this thing to zero. And likewise, you get all the profit that gets squeezed out, and they're the people who are just capitulating and saying, get me out. So again, on both of those macro metrics, we're at a very, very similar level that has flushed out those final sellers. So we're at that point where like the maximum pain that we've seen in previous cycles is pretty much in play in our current one. Now, moving on to the bottom two charts, this is the spending behavior on macro scale. How much wealth has been flushed out. Now, the way I'm looking at these, because obviously this is a daily phenomena, I'm looking at these on a yearly basis. So let's sum up all the profit and all the loss over a 365-day window and plot them one top, one bottom. Now, on the left-hand side, I've also got, this one's actually quite important. This blue trace is looking at over the course of the last year. So it's comparing basically how much did the market give back as a percent. So let's think about this. You can see here that the realized profits, let me just zoom in. Oh no, let me just take away, the takeaway here, note that the peaks are all at very similar levels for each of these bear cycles, right? So we're dealing with a peak that is very, very similar. So now let's explore what that peak means. If we go to the 2018 market cycle, the market locked in something like $116 billion in profits, right? So the market's happy. I've got $116 billion in the bank. Happy days. Then the bear market rolls around. A bunch of people get smoked. They bought the top, they sell the bottom, blah, blah, blah. Over the course of that period of time, how much got given back? And we're looking at about $52 billion. So on a percentage basis, the market gave back something like 44, 45, 48%, depending on where you want to measure from, but somewhere in the region of 45+% the market gave back, right? The other way to think about this, the amount that the realized cap rose over that year during the bull, it declined by 50% on the way back down. Now, here we are in our current market cycle. We locked in much more on a dollar value basis, $450 billion. And then we gave back something like, when this thing loads, we gave back 200 billion. So we took out 455 billion. We gave back 205 billion. That roughly equates to the exact same 48% or 46% of the gains made over the last year the market gave back in the bear. Again, we've kind of seen the market reset. In every cycle, we've seen this kind of 45 to 50% flush out of the gains made has been enough to reset the holder base. So again, we're looking at all these metrics in context, and it's giving us a little bit of conviction that there's just a lot of things saying it's not too bad. In terms of a deep value zone, it really looks quite remarkable, to be perfectly honest. We can then also take the ratio between these two on a relative basis. This kind of just develops an oscillator. You can clearly see the 4-year cycle. Really nice linear trend. Obviously, this is smoothed out over the years, so this is a macro oscillator, but you can see that we're essentially down at very low levels. I did the calc the other day. It's like 4.2% or something of all trading days have seen a worse profit ratio than where we currently are, and they've all been at bottoms. So anyway, there's a lot in there. I know realized profit and loss can be the general concepts. I think are fairly obvious. You buy a coin high, you sell it low, and or vice versa. The concept of realized and unrealized and gives you two different ballparks to look at it from. But when we break it down in both the macro and the micro, there's a lot of stuff here that's actually not too detrimental. I quite like the structure I see. And in many ways, it's kind of a time factor that I see now. We're just going through the motions of finally putting in the bottom. And in many ways, the bottom gets put in and you just don't know it until 6, 7, 12 months later when you look back and go, gee, turns out that was a bottom, right? All we can look at is the investor behavior. How are they reacting? The takeaway there is that we still have losses being locked in. There's still some people selling from the top. Most of them are long-term holders, but we also quite clearly have demand side. We have to because price is just a stable coin. So for every seller, there's a buyer. Someone's in there buying those coins, and we're going to see them most likely show up as short-term holders who are actually long-term holders, but because we measure it based on coin time or coin age, that's giving us that view that they look like short-term holders, but if you're buying right now, you're pretty hardcore. So we've kind of got that interesting match. But anyway, hopefully that's a useful session. Do feel free to drop me any questions if you have any, and I will see you in the next one. Cheers.